Thank you for joining. This is Bill Neville with the Entrust Group, and I'm happy to welcome Artem Milinchuk, who is here with FarmTogether, who's going to do a presentation about farmland investments. And obviously, from our standpoint, if you're looking to invest in farmland inside a retirement account, then that's the role that we play. Before I get too far into this, I want to remind you that we take questions at the end. So if you have either questions for myself about self-directed IRAs or for Artem about farmland investments and what he talks about, just go ahead and type them into the questions box, and we're going to answer all the questions at the end. Before I get started, as we always do, I'm going to mention that that Entrust Group is not an advisor. We don't promote or endorse any particular investments. So if you're looking to invest in something, make sure that you do your due diligence, talk to advisors, attorneys, or anybody else like that. Sorry for the background noise if you guys are hearing the clipping that's going on, but working from our home, this is the noise that we're subject to. So this is what we're going to talk about. First, I'm going to go over Entrust, then what exactly is a self-directed IRA, what are the benefits of self-direction, and then we're going to pass it on to FarmTogether, and Artem's going to handle the rest of it, and then we'll do the Q&A at the end. About me, I've been with Entrust now for, it says over 8 years. It's actually been a little over 9 years. Originally started with Entrust overseeing our franchise operations. I was manager of franchise operations, and we eventually did away with that program, and I was tasked to oversee our compliance and internal audit, which I did for a few years, and gave me some pretty good background and knowledge to lead me to the position I'm in now, which is business development manager. And essentially my role is to, on a daily basis, explain to people what a self-directed retirement account is. We've been in business for almost 40 years. The Entrust Trust Company acts as custodian, and then the Entrust Group provides all the record-keeping services for your self-directed retirement accounts. We currently have over 22,000 account holders. We're coming up on $4 billion in assets that we hold. And the big differentiator between ourselves and our competitors is that we provide a single point of contact. So if anybody opens an account with us, I'm one of 4 business development managers. I'm a regional business development manager. You would, depending upon who you're either referred by or what region you're in, you get that business development manager as a single point of contact. We each have an associate. So if you have any questions, need assistance, need help with paperwork or anything like that, instead of just calling the 800 number, you have a specific point of contact. For me, it would be me and my associate, Jacob. Instead of just calling the 800 number, get whoever happens to answer the phone. The majority of our staff are certified IRA service professionals. We have offices throughout the United States, but we're headquartered in Oakland, California. We have a national continuing education program for financial advisors, realtors, and certified financial planners, realtors, and CPAs. So if you're interested in our continuing education program, essentially we will do presentations, we will do a continuing education class for anybody who wants to set it up for a group. So for example, I've done a number of realtor associations. We have a 2-credit class here in California for local realtors, but I don't do it, on a one-on-one basis. It's if a realtor association or a realtor office wants me to come in and teach a class and provide the 2C credits, we do have that. And then we have the annual IRA Academy. So we are the only company in our space who trains other retirement account individuals on what they need to do to pass the Certified IRA Service Professionals class. So we are truly the leading educator in our industry. So what exactly is a self-directed IRA? Well, first of all, self-directed is not a type of IRA. A type of IRA would be a traditional IRA, a Roth IRA, a SEP, simple. We also have a 401k, a health savings account, and a Coverdale educational savings account. Any one of those accounts can be self-directed. You just have to have your account with a custodian who's willing to hold whatever asset you want to invest in. So the definition of self-directed is that you have a custodian where you make all your own investment decisions. We as Entrust, we don't advise you, we don't sell you any investments, we don't recommend or endorse any particular investment. and you can hold non-traditional assets. And a non-traditional asset is anything other than a publicly traded stock, bond, or mutual fund. So an IRA with us is exactly the same as an IRA with Fidelity or Charles Schwab, in that we're both regulated by the Internal Revenue Code. You're subject to all the same IRS rules and regulations. The only difference with us is that, again, we don't advise you and you can invest in non-traditional assets. So we are a platform provider. We don't offer investments. We provide the ability to make alternative investments and essentially diversify outside of just publicly traded stocks, bonds, and mutual funds. But you as the account holder, you have to do your own due diligence and vet your own investment. It's not something that we do on your behalf. All right. What are the benefits of self-direction? Well, you make your own investment choices. So if you're an expert in real estate, or if you know notes, or if you want to invest in cryptocurrency or the cannabis space or farmland or anything like that, this provides you the ability to do that. If you have knowledge or understanding of that, this gives you the flexibility and the ability to invest in those alternative assets. And diversify. Instead of being limited to just publicly traded stocks, bonds, and mutual funds, this allows you to diversify in other assets, other types of things that you know and understand. And then lastly, you get the tax benefit. If your IRA invests in real estate and you turn around and you flip it, you sell it at some point, there's no capital gains tax. There's no tax that has to be paid because the IRA owned the property, the IRA bought the property, the IRA sells the property, all the revenue goes directly back to the IRA. All right, so at this point, I'm gonna introduce Artem Milinchuk, who comes to us from FarmTogether, and I'm going to let him talk a little bit about himself, and he's going to take over the presentation from here. And then at the end, I'm going to step back in, and then we'll answer any questions that you ask. Type them into the questions box, and then I'm going to read them, and then it's either going to be me or Artem or both of us that answers the question. And feel free to stay as long as you want. So Artem, all you.
Thank you so much, Bill. Great to be on this webinar. We have a lot of self-directed IRAs as our investors, so definitely think that Farmland is a great asset class to add to your self-directed IRA. So before we start, just a little bit about myself as well as the team. I have over 10 years of experience investing in food, agriculture, and farmland. And together with our team and our advisors, we have over 70 years, having deployed $1.2 billion into the food and ag and farmland space. So definitely have quite a bit of inside institutional as well as kind of more retail into the space. It really is fascinating how farmland in a way is the oldest asset class, but somehow it's more exotic than what you call crypto cannabis, yet it's very fundamental to our life. And so we're excited to kind of rediscover this, if you will, and bring it to the broad audience. We truly believe that farmland, and we'll talk, why, belongs in everyone's portfolios, and everyone can benefit from having it in kind of financial planning strategy. So let's get started. Let's see if I can. All right, so FarmTogether is a data and tech powered platform for farmland investments. And what we mean by that is that on the sourcing side, we are using a fairly sophisticated amount of tools to find, identify the best farmland investments. There's a lot of farmland in the US. It's $2.5 trillion in the United States alone, and it's a very fragmented market. And in the segment that we look at, the $1 to $10 million farms, it's actually almost $500,000 farms. So very diversified, but very low information market. So it's important to use those tools to actually uncover the right opportunities. And then on the client side, the platform that we'll maybe have a minute or two to demo, it's really very seamless. There's an integration with Entrust. So if you're an Entrust client, it's really quite simple in a matter of minutes to add it to your IRA account and become a farmland owner. And our vision is to provide all investors with access to farmland investments, and farmers and farmland owners with access to capital. As I mentioned, farmland is the single most vital industry on our planet. I mean, it truly is. And if we kind of take water, which oftentimes is connected with farmland, then really that's the very first thing we need as we think about our basic needs as people. So we want to drive sustainable and prosperous food systems that work for everyone in what is a globally connected world, really, a small blue dot in the vastness of space. So just a little bit about disclaimers as well. This presentation should not be construed as an offer, invitation, recommendation in respect to FarmTogether securities. All forward-looking statements attributable to the company, the person acting on behalf apply only as of the day of this document and expressly qualified in the entirety by the cautionary statements included herein. So just give a few seconds kind of for people to look through this. All right, so why invest in American farmland? So farmland is actually a $10 trillion global market, and only less than 2% is owned by any kind of professional investors. And as we shift to the US market, which is 2.5 trillion, it's actually, I think, what a lot of people imagine when they think about kind of farmland investing, that there's this huge corporations and large pieces of land farmed with, this huge machines, industrial, and that happens a little bit, but really 97% of owners is families. And owner-operators, meaning farmers who own the land and operate it, 60%, and non-operated is 40%. But that 40% is really individuals. It's kind of the extended network of the people connected to farmland in some shape or form. So really, it's still way less structured than a lot of other asset classes. And for example, when we look at real estate, which is much more developed, it's interesting to note that the biggest segment of commercial real estate is multifamily segment at 2.9 trillion. So farmland is essentially the third largest real estate segment, if you want to look at it that way. The largest, of course, being single family house, a behemoth at something like tens of trillions of dollars. So it's a shame that farmland has been overlooked, but the reason for that, there's several of those reasons. Buying and managing farmland is complex. It's a very private nature of this market. It requires relationships with growers, operational expertise, and because there isn't right now, there's very few financial instruments to invest into it. And so that's what we're looking to solve. What I mentioned already, it's a very fragmented market. So what you have is in some other asset classes where for the larger financial players that create financial instruments, if they want to do, let's say, skyscrapers in New York, well, it's easy for them to just go build a tower and it'll be $500 million or a few $100 million and list it on the market, offered to investors. Farmland, you have to kind of move the needle for an investment platform to create that investment product. You need to accumulate hundreds of properties because they're truly not that big. And that's what we're looking to do, is what we're looking to use technology to make it much more efficient and offer eventually a diversified portfolio. And then what's important to know is that before, even if you wanted to invest in farmland, and if the broad investment community wanted to invest in farmland, it just wasn't that available. So right now we're going through this truly, not even a generational shift, a once in a history of the country shift of farmland ownership. So when people came to US and the Homestead Act and other legislation essentially gave the land, and it was a very fragmented market, and then the land would be passed on to children and grandchildren. And what's happening right now is that the average age of a farmer is approaching 60, but the next generation doesn't want to farm. A lot of kids don't want to stay, they move to the cities. And so we're seeing consolidation of farmland, farmers that remain becoming more professional, more kind of business oriented, more tech oriented, farming larger acreage. But what's happening is that about 70% of farmland, which is more than $1 trillion, is going to change hands in the next 20 years, about 90 billion every year. So a tremendous increase in farmland actually becoming available to outside investors for the first time. And that's kind of, answers part of the question, why now? So moving kind of to that why now question. We mentioned farmland changing hands. The other part that is sort of a larger trend is just this is a mistake, should say persistent low yields, not raw yields. But what's happening is that you have alternative investments emerging, and there has been a trend of almost, I think we have a slide on that. Yeah, so jumping to that slide, what's happening is that alternative investments have grown from 3.1 trillion in 2008 to almost 9 trillion now, and projected to reach 14 trillion. So overall, just farmland real estate, private credit, litigation, financing, all this what used to be considered more esoteric, exotic asset class, rapidly becoming mainstream. And that's because you have the interest rates are so low that capital has been flowing to other asset classes, bidding up, stocks and bonds and real estate and everything. And so capital keeps flowing to find other asset classes that haven't been tapped into it, and more importantly, that don't have the correlation. So we'll talk about that a little bit as well. But Farmland has, in our view, historically been attractive on a relative return basis, kind of risk-adjusted returns. It's also becoming attractive absolute return basis, where suddenly, 4-6% cash yields don't look as kind of low when your 10-year treasury is approaching zero. It's definitely a big change there. And then we talked about the new technologies. This is a big part of the value add of FarmTogether. Oh, 1 second, sorry. Big value add of FarmTogether is the proprietary tech that we're building to access this fragmented market. And we don't go too much into this part. It's proprietary to us, but really it's using everything from climate change models to geoimaging to natural language processing to read through thousands of pages of water regulations and listings to unearth the right opportunities and do it at scale and at a cost that makes them attractive. So moving on, we talked about the alternative asset class. So let's talk about Farmland as an asset class. And here we're showing kind of the longest returns we have. It's shows to 2015. If we extend it to 2020, it will be similar. And we can share that information as well. But this period has kind of the best data of comparison to other asset classes and the most well-researched period by the sources you can see below: University of Illinois, TIA, Center for Farmland Research, and CREEF, which is the Farmland Index, and Professor Bruce Sherrick, who's a good friend to us as well. So the returns have been quite attractive, 10.5%, and volatility has actually been fairly attractive as well at 6.4%. We'll talk a little bit about how that compares, but it's sort of higher than bonds, lower than stocks. But what's most important for especially a lot of institutional investors that are moving to this right now, and for anyone looking to build a truly diversified portfolio long term, and diversification matters, as we saw in 2008 crisis, as we see now. Farmland is virtually uncorrelated to actually negatively correlated, which is great with most other asset classes. And then the long-term tailwinds, I think everyone can understand what those are, but we have growing population projected to reach 9 billion by 2050. People also want to eat better, so there's improving diets, and farmland is actually decreasing. Every 5 years in the US, we're losing something like 40 million acres of farmland, which is almost twice the size of the state of Massachusetts. So, and that's due to climate change, is due to urbanization, it's due to that shift of farmers, kids moving to the cities, so the land just goes kind of barren, fallow. And then the other important points to note is that farmland, just by its very nature, has been very good in periods of recession and periods of inflation as well. So a lot to like about this asset class. So we talk about relative basis performance. So here we can show kind of the longer period as well. You can see farmland in the 1970 to 2018 period. And the reason kind of the numbers sometimes differ a little bit as we look at different periods, it's slightly different sources. Really, we'll talk a bit about this, but the Farmland Index was formed in 1992. So before that, the data is a little bit more scattered, might vary a little bit, there's different sources, but overall, the directional sense here is pretty clear, which is it's done quite well in its historical performance with low volatility, which has led to, what professional asset managers refer to as Sharpe ratio, essentially return divided by volatility, and it's really done quite well. You can see the real assets have also done quite well. So we definitely believe Farmland is part of the real assets group, and when you're adding things and to your portfolio that you want to have that real intrinsic value to be kind of uncorrelated, whether it's by kind of historical standards or just by the very first principles basis to the broader market, things like gold, that we call Farmland Gold with a coupon, Farmland, water, sometimes cryptocurrency as well, kind of fits in that bucket. And definitely a lot of our investors, that's how they view farmland. They come to us and they say, look, I got some gold, I got some farmland. I'm trying to have a hedge against extreme events in the financial system. I want to have something that no matter what grows real things, grows food that we'll have to buy, no matter what happens to the world. And so definitely farmland delivers that, but also actually quite attractive returns. Now, our personal view is that the returns we have seen historically in most asset classes, it might be a little bit hard to repeat because it was driven by falling interest rates, which leads to mathematical decrease in the discount rate in the DCF, which then leads to higher asset prices. Really not much lower that interest rates can go. So for most, when you look at the long-term forecasts of asset classes by companies like JP Morgan or BlackRock, really, they're forecasting about 5% for equities long-term. A little less for real estate. So definitely, I think if you look at headlines, you see things like lost decades for stocks coming up. So both for farmland, for other asset classes, our belief is that those returns as an asset class unlikely to repeat. But maybe we could be wrong. But overall, definitely strong performance. So moving on. So what's really important to note is that farmland is a very powerful engine for impact. When we look at our investments, we believe that farmland can impact 8 out of 17 UN Sustainable Development Goals. And so it's not just lip service greenwashing. When we mention this, we're actively working on becoming signatories to both domestic and international standards for impact investing, as well as specifically farmland investing. And there'll be very clear metrics and goals that we will have to achieve in order to qualify. So one thing to mention, our COO, he has a majored in climate science. And the reason he went into farmland during FarmTogether is because he believes that we know enough now about climate change, and that farmland actually can be one of the few, not only industries that done right can actually be a carbon sink, not only carbon neutral, but carbon negative, actually capturing carbon into soil. So it's part of what's also called regenerative agriculture. And that's why we are part of, for example, an initiative called the Terraton Challenge, which is led by Indigo, one of the largest kind of carbon trading groups in farmland, together with other organizations such as American Farmland Trust and many other great entrepreneurs and companies looking to drive achieving sustainable goals within the farmland space. So a little bit more about performance by farmland type and how you can think about the returns for farmland. So maybe a little bit kind of cheekily, if you will, but you can compare farmland types to bond types. So in bonds, you have high yield bonds and you have your investment grade bonds, your AAAs. And in farmland, you have a little bit similar, where you have annual row crop farmland and permanent crops. So annual row crop farmland is your soybean, your corn, your chickpeas, really everything that you kind of plant every year. It's typically very stable returns. If you look in the bottom, it shows 2 types of returns: income and appreciation. And so just to expand a little bit on how do you actually make money from farmland, it's very much like real estate, where your returns are renting out the land to the farmer. And what's interesting is that 40% of farmland is rented already. So it's a very common practice to rent out farmland. You collect your rent check. Sometimes it's just an annual fixed lease that you collect every year, or it can be a revenue share or profit share. And so row crop farmland is typically more of that lease or flex lease, that it's called, type investment. And if you look in the bottom left, you'll see how incredibly stable that income has been. Now it's been falling steadily because, again, of interest rates and appreciation in land, but it's very rare to not rent out your land to a farmer. It's a very vibrant rental market, and that's what's called a zero vacancy market, where the tenancy risk is extremely low, which actually compares very favorable to real estate, where right now, what's supposed to be super safe and stable real estate is struggling with collecting rent or with tenants due to COVID. And then you also have price appreciation, that you go through periods of that cycles of appreciation and you get kind of subdued periods. But what's interesting to note here is you can see there wasn't a single negative year in both appreciation of fund as well as income. So when we talk about volatility, this is something really that you can invest and forget, and IRA is a perfect place for that. You can put it in 30 years, unlike tech stocks or God knows what happens to crypto. Farmland's going to be around. I mean, we're looking at farms right now in our deals that have been farmed for a century. So it's one of those invest and forget investments. You can invest it and think about your kids and grandkids, think about whether it's your endowment or foundation. It's really something that is an ultra long-term stable investment that delivers that coupon, that cash yield for many years to come. So now if we go to the right, this is kind of the bad boy of farmland investing. It's a little bit riskier, but definitely high returns as well. So this is the permanent crop space. This is your almonds, your pistachios, your walnuts, citruses, really everything that is permanent where you plant trees. So because you're planting trees, there's more risk of the damage to the trees, and you also care more about long-term alignment of the farmer with your farm. So this is typically longer-term leases, revenue share, profit share, and because your end market is typically more volatile, you can see that the returns here have been more volatile. They also have been higher. So raw crops, if we look at sort of the returns there, long-term right now we expect about 7-8% total return raw crop farmland. In permanent crops, you would expect something like 12%, 10 to 12%. So definitely periods of really high returns, high appreciation. Here you can find deals that once sort of the trees mature, you're getting cash yields that are 6%, 8%, 10% or more. So also what we have seen with our investors is that quite a few of our investors are sort of professionals in their 40s and their 50s. And so they're investing into this for the long term so that when they're retiring, they can say that, look, this cash flow will offset my expenses that I'm planning for. And it really is, a nice coupon. And you get sometimes, it will be 6%, sometimes 8, sometimes 10, sometimes 12, sometimes can be 4. But overall, every year you're getting that coupon and you can see sort of how it has performed historically. So we always strongly recommend for people to diversify both within permanent crops and across the crop types. And you can do that increasingly more and more on our platform. So anyway, thank you for wanting to kind of pause here because this is an important slide just to talk about the types of farmland. So moving on. What makes farmland a strong all-weather asset class, no pun intended, is its inflation hedge. So let's talk a little bit about that. Farmland products, especially raw crop products, they go into thousands of industries. We're talking about feed, we're talking about food, feed meaning for animals, food, we're talking about fiber, we're talking about things like penicillin. So really products like corn, soybean, they go into thousands of derivative products. So when we say inflation, in a way, that is the inflation. So farmland has performed historically really well in periods of inflation. It's uncorrelated, as we mentioned as well. And then dual return, meaning that you get both price appreciation and cash income. So let me talk a little bit about what drives price appreciation. There are several drivers that have allowed farmland to actually show a annual price appreciation over the last 50 years. That was 5.9%, so very high. Again, we don't think that's going to repeat going forward. That's not how we underwrite. But let me unpack why that was. So partially, as we mentioned, it's decreasing supply of farmland, just so you don't make it anymore, while you have improving diets, increasing population. Secondly, what you have is a little bit kind of a, I shouldn't call it Moore's law, but it's a very sustainable long-term trend of improving yields that a farm can deliver. So we're talking here things like ag tech, green revolution, improvements in seed, improvements in irrigation, So that improvement historically has been about 3.2% from 1947 to today. So every year, the yields on average increase by that much. And that improvement in yield flows ultimately to the price of the land. You also have inflation, so farmer moves with inflation. And then you have sort of individual pockets where if you have, let's say, good water in California and other places have bad water, those farms will go away. So, the supply decreases, and that means that farms that remain increase in value. So that's what's been driving, very defensible and kind of, in our view, easily forecastable long-term trends in farmland prices. Okay, so moving on, just I think this touching back to the alternative investments, it's the need for yield diversification. So a little bit more about the returns across asset classes. So adding a bit more here, and this I think presentation recording will be available. So some of the slides are more for you to kind of review afterwards. I won't stop too long on some of them, but you can see farmland being kind of stable, pretty stable, and then you have stocks up, down, and very volatile. Gold has its periods as well of quite negative periods. You have your US bonds being more stable, in real estate, of course, 2008-9 crisis, and we'll see how it performs in this period as well. Just a point on the last that we recently got the information, the Q1 performance of farmland. And this is the first, I think, quarter or the first year that it might be slightly negative. And when negative, we mean minus 0.1, 0.2%, whereas everything else fell by 3 to 30 to 50%. And we think that actually on a total year basis, farmland will be at to slightly up as kind of the the overall economy recovers. So still delivering that defensibility. And just a bit more on the correlation to specific asset classes here. So you can see with real estate, it's been the most correlated in the kind of last period where we have good data, and negative correlated to 0 to stocks, bonds, and gold. So very good diversify. I mean, if you remember 2008-9 when everything suddenly became correlated, this is really a great asset class for diversification. Talking about 2008 crisis, from Q4 2007 to Q4 2009, farmland was up to 20% plus, where everything else, you remember, was down 30, 40%. So again, really good diversifier. All right, and I think that's about it. I believe we have a number of questions, so thank you for listening. Bill, not sure if you want to kind of go through them or if I should be kind of looking at the, yeah.
So thanks, Artem, for your presentation. If you do decide that you want to move forward with opening an account and investing in farmland or any other alternative assets, you can just do it by opening an account. It takes about 10 minutes. Then you need to fund your account by transferring or rolling over from your existing account or making an annual contribution. If it's coming from an existing IRA, you process as a transfer. If it's coming from a qualified plan like a 401k or a 403b, then you do it as a rollover. And then you instruct Entrust to purchase your investment. It's really very straightforward. All right, so we're going to answer questions for you now. I'm going to leave mine and Artem's contact information up here. And again, if you have questions, just type it into the questions box and we'll get to it. All right, so the first question. Assuming we are rolling over assets from other qualified plans, like a 403b, 401k, and the funds are not sufficient for even a down payment, I'm also assuming that other funds can be commingled somehow. So Mark, the answer to the question is yes. Your IRA can be partnered with other investors, including yourself, including other IRAs. Now, if you're going to partner with what would typically be a disqualified person, such as yourself, then you have to structure that partnering arrangement at the time of the investment. So, for example, if you already own a property, then your IRA can't come in as an investor on that property because that's considered you are a disqualified person, and that's considered a prohibited transaction. But if you want to buy a new property, then you can structure it so that where your IRA is a percentage owner and you personally are a percentage owner on that investment. Next question. With 70% of farmland coming onto the market in the next 20 years, that sounds like increasing supply, not decreasing. How does this not produce downward pressure on farmland price? Also, if the next generation does not want to farm, how is this land going to produce income?
Yeah, Bill, let me answer that. So when we talk about supply, we mean about new farmland becoming available, and there's no new farmland becoming available. It's of course, you can like in Brazil, burn down forests, you kind of introduce farmland, but when you talk about farmland amount, acres overall, maybe it shouldn't use the word supply, but just amount of farmland overall, that size is decreasing. In terms of farmland coming to the market and sort of coming for sale, it's not driving down prices. Prices keep going up. There is the demand, both from kind of all types of investors, is just too high to kind of drive down. Like I get what the question is asking, which is if you have more farms being sold, shouldn't the prices go down? No, it's just the demand is too high to kind of realize that. So it's more plus part of that is still going to be passed on to the kids. So it's not all 90 billion kind of coming to the market. Secondly, the question on kind of, I think it was who's going to kind of farm, right? If everyone is moving to the city.
Okay, next question. Again, this is another one for you, Artem. Climate change was mentioned.
Sorry, Bill, just to make sure I understood the previous question. Can you read the second part of the question again?
Also, if the next generation does not want to farm, how is this land going to produce income?
Got it. Yeah. So there's still so what's happening is that there's fewer farmers, and as mentioned, the farmers that stay back, they farm larger acreage. And when we talk actually about how we help farmers, farmers oftentimes come to us and say, look, a neighbor is selling or someone else around is selling. I don't want to tie up my capital in buying the land. I want to farm it for you. And so why don't you, here's the information, why don't you go buy it and lease it to us so we have a kind of a contract farming agreement. So there's still farmers remaining, and they just became more sophisticated and farming larger amount of acres.
Okay, next question. Climate change was mentioned. How do we protect against climate change making a farmland investment non-productive? Diversification would seem to be more important for this investment class. Thoughts?
So that's part of our underwriting is we look at actually climate change models. We look at what does it do to temperatures, to water. It's a big part of our underwriting. We right now, for example, looking into water districts in California, understanding how they change and how water availability changes based on both the new regulations as well as climate change. So that's kind of core part of what we do is taking that into account. But you're absolutely right as well that diversification is important for this and other asset classes. Some places, though, you just you cannot diversify away. So, for example, California grows 80% of almonds in such a vibrant industry that you can still diversify within different counties, different water districts, but it's a unique climate that is really quite attractive for this. Now, there's other places growing almonds, but that's kind of part of the overall big thesis here is that you have to understand climate change and what it's going to do to farmland prices. Flip side of that is that we're increasingly looking at places like Canada, northern states, that every 5 years seem to be getting another 1 to 2 warm growing days, and that increases the value of land. So yeah, good question.
Okay, another one for you, Artem. How will indoor farming influence your investment strategy, if at all?
Sorry, Bill, can you repeat that question?
How will indoor farming Oh, wait, there's more to it. Yeah, how will indoor farming influence your investment strategy, if at all?
Yeah, so indoor farming just cannot compete um, as a kind of a type with outdoor farming. Nothing really beats uh, scale, beats free energy from the sun, free water from the rain. If you're talking about places like row crops, and also nothing beats the inherent resilience and diversity that exists outside. So farms, indoor farms, they sometimes struggle with infestations and sort of screwing up of the microbiome that goes on. But having said that, for some areas and some produce types, indoor farming works tremendously well. People mention cannabis, and that's one. We don't touch cannabis. Leafy greens work well, especially near places like New York where you have restaurants. Um, Herbs as well. But overall, we think farming on the margins might eat away from some of those types of products. But overall, it's just really hard to kind of beat Mother Earth. And then lastly, we might even have an indoor farming offering on our platform in the future.
Okay, next question. He first said, great presentation, thanks. I thought permanent crops had depreciation benefits. Wouldn't I want to hold them outside of a self-directed IRA and have row crop investments inside an IRA? So I'm gonna talk about this for a second. I'm gonna let Artem chime in if he has some thoughts. So I get that question fairly frequently in terms of holding real estate inside an IRA versus outside an IRA, and the fact that you can't write off depreciation. And my comment to people typically is there's nothing that precludes you from holding real estate in both. I mean, if you want to hold real estate outside an IRA and get the depreciation benefits, but that doesn't mean that you can't also hold a real estate inside an IRA, because your decision of whether or not to invest in something inside a retirement account should come down to, is this the investment that I think is best equipped to grow my retirement account? So oftentimes the decision doesn't come down to inside or outside the account. It comes down to, do I want to invest in farmland, or do I want to invest in publicly traded stocks, bonds, and mutual funds? Or do I want to invest in precious metals, or do I want to invest in stocks or in real estate or in whatever, right? Like ultimately, the decision of what to invest in inside your retirement account should be driven solely by, what do you think is the asset that is best equipped to grow your retirement account? And I mean, if you want to consider, like, if you have the choice, if you're in the fortunate position where you have enough money in your savings account as well as in your IRA that says, well, like, I can choose to invest in this in my personal savings and then this in my IRA, and diversify your holdings that way, then yeah, I mean, depreciation can certainly play a part in that. But there are certainly a lot of people who don't have a lot of extra money to invest in farmland if they wanted to, or in any other kind of investment than in their savings, because they're too busy just paying their daily bills, that where their money is, where they have money to invest, is inside their retirement account. So they don't necessarily have the option to choose inside or outside. They simply say, I have a retirement account. I want to invest it in something. I want to grow my retirement account. What are the assets that I think is best equipped to grow my retirement account? And they make the decision accordingly, and depreciation doesn't really, play a factor in that one way or the other. Artem, I don't know if you have anything you want to add to that. Or if you have any thoughts in terms of, like, permanent crops have depreciation benefits, whereas what does he say? Row crop investments don't have depreciation benefits. I don't know if you know the tax rules associated with that.
Yeah, no, it's true. Yeah, row crops typically have fewer depreciation benefits. Also to mention, sometimes farmland can also fall into the QIZ zone, so that happens. We also, permanent crops, yes, there's depreciation benefits. It depends. If it's a development, you'll have way more in the way of depreciation benefits, less so in mature orchards. You also have typically a bit more equipment on the farm, such as irrigation, wind machines, on permanent crop side that give you a little bit more depreciation. I think, Bill, what you said, was dead on. Is you can hold some in IRA, some in not IRA. Really depends.
Yeah, it depends upon your investment strategy and what other investments you have, and it's a personal decision. We're not trying to encourage people to do one or the other. Like this is educational, just to bring out the awareness that this is an investment that you're allowed to do inside an IRA if you want, or outside. Okay, Artem, is FarmTogether a privately held entity or a public company?
We're a privately held entity.
Yeah, I figured as much. Okay.
One day, Bill, one day.
Yeah. What has been the impact of commodity volatility? Excuse me. What has been the impact of commodity volatility in farm products?
Yeah, that's a good question. When we look at correlation of farmland to commodity prices, it's actually almost zero. But let me unpack that a little bit, because of course, how can that be? So if we can, we can stay on this one, but if you recall the row crop slide I showed and returned there, the commodity prices were very volatile in that period, right? We have periods going up and down because it's more of a lease model with a bit of that, revenue share. Your exposure to commodity prices exists, but it's maybe like 10 to 20% of your cash yield per year. So really, farmland moves with long-term commodity prices. So, if we think corn is going to be permanently $3.5 a bushel, and that's the long-term price, versus maybe $4.5, then of course that will, decrease some of the row crop prices. We also have soybeans, so that's another one that farmland grows. We have some variability in what farmland can grow. So overall, of course, the long-term trends matter, but short-term trends like right now, they had small effect, let's say, on the cash yields that row crop farms received this year. I mean, some downtrend for sure, but not something that you would expect that would be 50% drop. If there's 50% drop in commodity prices, that does not translate to 50% drop in your income at all. So it's a little bit like when you think about owning a building and renting it out to, Starbucks, right? And Starbucks coffee prices might fluctuate, but your lease isn't really going to change that much to them. So it's a little bit like that. Of course, there's a bit more correlation there. Now, with permanent crop prices, as you saw in high volatility, commodity prices matter more. And your revenues will also fluctuate more with the short-term commodity prices. And that's because typically in permanent crops, you have more of a revenue share or a profit share model in your income returns. The way we address that and underwrite that, we like to underwrite at forecast prices that are at or below historical averages. So for example, we look at almonds, we don't want to assume that almond prices will go up by X. We want to kind of look at what the historical 10-year was, 5-year was. We want to also have our models that use a bottoms-up analysis, looking at the demand, supply in the end markets, what's driving the almond prices, not just slapping a number on the model. So for every deal, you also will be able to see how we're thinking about the end markets, and why we think the commodity prices we forecast are defensible.
Okay, next question, I'm going to answer this one. How is the farm income handled in the IRA? So any investment that's made by an IRA, any income or revenue generated gets paid back by the IRA. So if you were to invest in farmland or, again, any other investment, let's say with Entrust, standard naming convention for a retirement account is custodian name for benefit of client's name and account number. So that farm would be held in the name of the Entrust Group FBO for benefit of your name, IRA number, and then whatever your account number is once you establish the account with Entrust. So any income that's generated from that investment gets paid back to the Entrust Group FBO, your name and account number, and sent directly to us, and we deposit it in the account. Next question, before I read the question, so one of our sort of requirements, or I guess guidelines from a standpoint of that we're a neutral third-party record keeper, is that we don't sell any investments. And so when we do these webinars, these monthly webinars, they have to be purely educational, which means that investment sponsors that we bring on and subject matter experts like Artem, we specifically tell them that they can't talk about their returns, their specific investments, in essentially anything that can look like he's selling or promoting his specific investment. So for this next question, I'm going to go ahead and read it, but I'm going to not let Artem answer it. I'm just going to tell him Artem's contact information is there. There's his email. Please reach out directly to him and ask this question, which is, can you describe a typical investment, minimum investment, targeted returns, et cetera? That's just, it's not information that we can let him go into on this webinar because it's purely educational. So, but Howard, we'll also pass on your contact information to Artem as well, so he can reach out to you or you can reach out to him. Next question, is there a way to only invest in farms focused on regenerative agriculture? Artem?
Sorry, Bill, you broke up a little bit. Can you repeat the question?
Yeah, is there a way to only invest in farms focused on regenerative agriculture?
Yes. So on our platform, you can invest on a deal-by-deal basis, and we're actively working right now to bring regenerative deals to the platform as well.
Okay. Next question is about fees. What are fees charged by the Entrust Group and/or FarmTogether? I mean, our fees are listed on our website, so instead of going into, running through them, I would encourage you to just go to the entrustgroup.com, and you'll see right up next to the green login button, it says fees, and just click on our fees, and you can go ahead and check those out. And Artem, I don't know if you've got a quick, if you want to send them somewhere to check out your fees, or if you just got.
Yeah, absolutely, and yeah, Bill, and in the spirit of kind of not going into too much detail, but we can say that Entrust fees are very reasonable.
Well, and they're also your fees. Yeah.
Yep. And our fees also on the website is by deal basis. So typically it's 1% management fee and a one-time 1% expense reimbursement fee. It varies a little bit deal by deal. So overall, right now, our goal isn't to try to maximize our fees to, charge as much as we possibly can. Our goal is to prove ourselves on the market, to do a great job in this first 5 years, show excellent returns, and really earn the trust of the market. So, versus established funds in the space, our fees are quite low, whereas the team comes from those funds. So we think we have not just good deals, but also competitively priced fees.
Okay, and then next question is basically the same thing. What is the cost to invest in the farmland? Again, check out their website, reach out to Artem, but it's on a deal-by-deal basis. And then obviously, if you're curious about our fees, although I know I recognize the name, you're an account holder, so you know our fees. This is a yes or no question, so I'd like for you to, is there a minimum to invest? Do you guys have a minimum?
Yes, typically it's 15,000. Sometimes it goes as low as 10,000. And given kind of the strong demand, the minimums are shifting up a little bit. So I would definitely kind of encourage people to kind of hurry up and start investing now.
All right. So next question is farmland investment like real estate, where you will need to apply for a mortgage?
Yes, but it's not you, the investor, that would apply for mortgage. Some deals indeed have debt on it. The debt in farmland is very attractively priced. It's very long term. You can get 30, 50 year, loans at 3.5%, 4%. So, on some deals we do that to improve the returns for our investors and to give them that benefit of, leverage, on the asset level that they couldn't get themselves. Typically, which we don't do kind of aggressive debt leverage. It's really, 30 to 40%. Maybe up to 50%. So nothing crazy. Yeah.
Okay. Next one, it's another one related to climate change. How do you take into account the future impact of climate change? Do you invest in different regions and not all regions of the country?
Yes. So the way we kind of look at it, there's a number of different climate change models. Some of them, very very easy to use to see what happens to things like precipitation and temperature. When we kind of do our analysis and underwriting, we look to overlay that into what goes into the model, basically. So,
Okay, some really interesting questions on this one. Has the tariff situation with China and the EU been a problem?
Absolutely, yeah. The tariffs from China have been prohibitive for soybeans, so it led to a big drop in soybean prices. Our view right now as we underwrite, so meaning, I can have a personal view on China, but as a company, how we underwrite is that we essentially assume that the trade war and the restriction will stay in place forever. So when we look at the prices that we assume for farmland, that's the prices we kind of assume. It hasn't led to a drop in farmland prices, so maybe, we could assume that it didn't lead to an increase in farm price that would have been. And that's again because it's just the attractiveness of farmland as an investment, as well as an operating asset for farmers, just gives tremendous resilience to it in terms of pricing. So we look to buy farmland typically in the areas that are impacted by China at 10-15% discount. And I tell you, it's a competitive process. It's not that easy to find deals, even in this environment. And I think partially is, what's good about this approach is that if you have a different view on China, if you think the trade wars will resolve themselves, then you get to capture that upside in the returns when you invest with us. So you kind of see that we're kind of looking at this. Our view is sort of we are nearing the bottom of the cycle, or at the bottom of the cycle in terms of some of the commodity pricing. And so I'd rather be here than, let's say, 5 years ago when we had a very strong run up in prices, and then the next 5 years had sort of a more subdued environment, still like healthy asset returns of 7-8% overall, and definitely strong returns in individual groups, like for example almonds had some good years. So within sort of the China trade wars, you also have realignment and kind of rejigging of the flows of commodities, because the thing to remember is the amount of people didn't suddenly change. And the amount of food consumed didn't change. It's just that now China is buying Brazilian soybeans, so the US soybeans need to find a different market. That may mean rejigging the supply chains, which means to kind of higher cost of those supplies. But the overall supply demand is the same. So there's also an adjustment of where the different products go to. And so we do anticipate some recovery, even if the China trade wars don't resolve themselves.
Okay. What are your views on the advantages of availability of water in the Southeast U.S. as compared to Midwest and California?
Right. Oh man, that's definitely, I think, I cannot answer this question right now. We'll have to look into the specific of which regions for which crops, which water district. It's very specific. Even within California, on the overall level, yes, California went through a drought. The new regulation SGMA is putting restrictions on water use, which is expected to lead to 1 million acres going fallow. But within those regions, you have farms that have excellent water rights, that no matter kind of what happens, still get all the water allocation. So it's always more nuanced. But if you have more information, the person asking the question, please reach out. If any specific regions, we'll see if we can answer on that question.
Okay. Do you have to be a accredited investor in order to invest with FarmTogether?
Yes, right now you do. We are looking at introducing options for non-accredited investors as well. Just takes longer. The regulations are more complicated. We also want to make sure that we take good care of all investors, provide a high quality level of service and education. And so it's just a little bit harder when it's more investors. So, but as part of our core mission, we want to democratize farmland investing, farmland ownership. So we'll be working on that for sure. And there's more news to come there.
He also asked what is the minimum investment amount. You covered that, as did somebody else ask that. But basically 15, although you've gone as low as 10, and they're on the rise
Yes,
a
sir.
little bit to repeat your answer. Next question.
Yep.
Here's one for me. Can I roll over a 401k? Sorry, got deleted as I was reading it. Can I roll over a 401k to an Entrust 401k and invest in farming? Yes. I mean, it would technically. If you have a 401k currently and you want a 401k with Entrust, our 401k is an individual 401k. So you have to be a business owner or self-employed, and you can't have employees. You can only have other partners in the business in order to have our 401k. Otherwise, you would roll it over from a 401k to an IRA. But I mean, obviously, you can invest in farmland. Bear in mind, any investment that you do in an IRA has to be for investment purposes only. It can't be for personal use, which means, for example, if you as the account holder want to buy farmland in your retirement account, you can't work the land, right? You're considered a disqualified person. So you would have to contract that out or hire other people to do it. The IRA would have to pay it. We could go down a rabbit hole with explaining that, but if it's something that you're considering, reach out to me. We can discuss the rules, but you can certainly, I mean, that's the whole reason why we're doing this presentation, is to bring awareness to farmland as an investment opportunity that you're allowed to do inside a retirement account. But as always, make sure you do your research and due diligence and talk to the farmland experts about, the value in it. Okay, location, location, location is a common mantra in real estate. Does this apply to the farmland investment?
To an extent. You want to be in an area that is a very vibrant farming market. And what it means is that the ecosystem is there. So for example, the area around Fresno, the Modesto, Merced counties that are big almond, kind of an almond belt, if you will, or Oregon that has a hazelnut belt. And what it does is that it just means that you have less reliance on one particular farmer and one particular supplier. So that helps. And then secondly, of course, if we talk about location, things like water in the right water district for a lot of permanent crops, yes, as well. But also things like soil matter a lot. So I would say if it's real estate, it's like location, location, location. For farmland, it's location, location. So just two locations, but still very important.
All right, one less location.
Yeah.
Since the total value of an IRA has to be reported to the government every year, who would provide the value of FarmTogether land? Entrust would reach out to FarmTogether, or would FarmTogether provide the information at the end of the year to me and I would report to Entrust? So
yeah, Bill, we would provide this to you. Yeah.
Yeah. So you're not investing directly in farmland. You're investing in an offering from FarmTogether, and FarmTogether's investing in the farmland. So you'd hold a percentage of an offering with FarmTogether, and so you as the account holder would be responsible for completing our fair market valuation form, but FarmTogether would provide the valuation to you and likely sign as a third party signatory on behalf of the form that's reporting the value. So in effect, yeah, FarmTogether would give it to you and then you would give it to us. And then the next question, the last question that I've got on there, so for those who are still left, if you have any questions, get them in. Can you say anything about UBTI taxes across farmland investment types? So UBTI, unrelated business taxable income or unrelated business income tax. If your investment is using leverage, then your IRA is potentially subject to what's called unrelated business income tax, or in this example, unrelated debt financed income tax. It may be subject to that. So I'm going to give an example of how it works, and then and then Artem can potentially throw in some thoughts if he wants to. But let's say your IRA, I'm going to not look at farmland specifically, but just real estate in general, and say if your IRA invests in a real estate, a rental property, for example, and your IRA comes up with 50% of the money and your IRA borrows the other 50%. Now note it's not you that's borrowing the money, it's your IRA that's borrowing the money. What the IRS looks at that and says is, okay, well, 50% of that money came from the IRA, so it's tax protected, but the other 50% came from outside leverage, which means it's not sheltered. It's not tax sheltered because it isn't IRA money. So what the IRS says is 50% of any earnings generated by that investment is subject to unrelated business income tax. So if you were to, in a year, earn, let's say $10,000, you invest $100,000, 50,000 from your IRA, 50,000 is borrowed. So 50% of your investment is borrowed money. Then the IRS says, okay, 50% of that you have to pay tax on. So if you earn, let's say, $10,000 net income in that year, then they're going to look at that and say, okay, well, 5,000 of that came from borrowed money. It came from non-IRA money, which means that your IRA doesn't get the benefit of 100% of the revenue generated from the 50% borrowed to the IRA. So that 50% or 5,000 of the $10,000 would be subject to unrelated business income tax. How this would apply to FarmTogether, because you're not investing directly in the farm, you're investing into FarmTogether, is that if FarmTogether creates an entity that's going to buy farmland, and FarmTogether through that entity is using leverage, then potentially a portion of your IRA, income generated by your IRA from this investment, could be subject to unrelated business income tax based on the percentage that FarmTogether borrowed. Okay, I mean, hopefully that makes sense. All right, so we got a couple more questions. Does this mean that if there's no leverage at all, there can be no UBTI, UBIT? Typically, yes. If there's no leverage being involved, then your IRA is typically not going to be subject to UBIT. Right now, UBIT is also applied that if you're essentially your IRA is running a business. So UBIT can also be involved if, let's say, you use your IRA to buy a franchise, right? And now your IRA isn't just investing in a business, but your IRA is running a business or it owns a business. Then that can be subject to UBIT, which is separate, because UBIT is actually made up of unrelated business income tax or unrelated debt financed income tax, which it's the opposite side of the same coin. The tax rates are the same, but one has to do with your IRA running a business. The other one has to do with your IRA borrowing money, right? Or investing in an entity that, in this case, land that used borrowed money. So when it comes to farmland in this instance, because you would investing with FarmTogether would not be running an investment. It would be an investment. I'm sorry, it would not be running a business. It would be making an investment. And so ultimately, you would only be subject to UBIT if FarmTogether used the leverage for that specific entity. Okay. And Artem, do you have anything you want to add to that?
Bill, that was you're very informed. You're very informed. That was an excellent summary of something that sometimes can be very confusing to people. So
yeah,
really great
it's
job.
It's very IRA specific. Yeah, if they're not using leverage, then you should be fine.
Indeed. So yes, some deals indeed use leverage, and honestly, I think like it's for every individual to decide, and sometimes it's just an administrative burden. But one thing we're doing is just making it very easy to do filing. So we provide K1s electronically, provide reports to the IRAs electronically. And I think, both you as well as the industry overall, just developing more tools to make filings easier, because, we all want to minimize the headache. Like, trust me, I hate paperwork. So indeed, some deals might have UBTI, but partially we hope that will be offset by the high returns because of using leverage. So that's part of it. And then, as we talked again about whether to put it into IRA or not, maybe, some of those deals shouldn't go into an IRA and some should. But overall, I think what I like about farmland in IRA, because it's kind of philosophically aligns with the long-term view of investment and the whole period for farmland and the IRA nature.
Yeah. Yeah, and again, if it's a question to ask, and what it comes down to is it's going to impact potentially your rate of return. So if they're using leverage, and so that means that a percentage of your return on investment, not your whole entire return, but again, if you generate a return on investment in a given year and they use leverage, a percentage of that return could be subject to UBIT, right? But what that means is that, like, if you're looking at an investment and saying, well, it's expected to get a 15% return, but maybe because there's UBIT that needs to be paid, that just becomes an expense that has to be paid out of the account. So maybe your net return on investment is going to end up being, let's say, 12% or 13% rather than 15%. So it simply comes down to, when calculating your return on investment and whether it's an investment you want to make, don't forget to ask about it and include that in as, I guess, an impact on what your return on investment would be, because it's gonna affect it, and it could potentially affect it in a downward way, but usually not more than a couple percent, right? So, I wouldn't let that tail wag the dog, right? Just bear in mind it's an expense that your IRA might have to pay that's going to lower your return on investment, your anticipated return on investment. Like the same way that a mutual fund. Yeah, go ahead.
Yeah, no, I was just going to say, on that note, maybe kind of a personal plea almost, but sometimes people get too focused on taxes, and really you just got to look at everything on maybe an after-tax return basis.
Yeah.
So that's all I wanted to say. Yeah.
And then how does your return compare to what whether you want to invest in a mutual fund? Okay, so next question. Farming yields are largely driven by the knowledge and skill of the operator. How does the investor have any assurance of competence in their operator?
So again, talking about two types of investments. In row crops, it's way less so. Your rent is not tied to the yield of the farmer. It is a cash rent that's paid upfront, and then there's also a flexible component that is purely dependent on the Chicago, the seaboard corn or soybean future prices. So you have zero exposure to what the farmer does kind of on the farmland, except for making sure that the fertilizer amount is the same when they started farming and then when they give the land back to you. It's typically 1 to 3 year basis. Now on the permanent crops, exactly right. And that's where FarmTogether comes in. That's what we get paid for, is that we select very reputable operators. Some of them have been operating for 40 years for large institutional investment funds. We use tools to monitor the farming. We hire internally farming managers that are farmers or come from that background to manage that as well and provide that oversight. So, the good thing is that because of our background in institutional investing, we have relationships with really excellent institutional grade operators that have done this for many years. They understand the need for quality. They understand that their reputation is on the line. And so far, we've had quite good results, without naming any numbers, of course, or any details, but on some of our deals, we've seen already returns above projected. So I think that's kind of what you pay us for, is to select the right operators and provide the right oversight of the farms.
Okay, and last question. This one, Artem, you might want to take off here. But he says, does FarmTogether also invest in pasture land? And then he adds on, my sisters and I will be selling a 6,000 acre ranch in Oklahoma. Great native grasses, has sustainably run cattle, etc. So sounds like somebody might want to be doing a deal with you. So, I mean, do you guys invest in pasture land? And again, you're gonna get people's contact info for this type of thing, so you can reach out to them if you're interested in doing business with them. Artem?
Sorry, Bill, was that a question to me?
Well, yeah, the question was, does FarmTogether also invest in pasture land? That was the short question.
Oh, understood. Yeah, sorry, I misheard you. We don't invest into pasture land at the moment, but it is kind of the second large segment of farmland, the 2.5 trillion pasture land, depending on how you count, but it's at least another trillion there. Not at the moment. We'd like to, so stay tuned.
All right, very good. That was the last question. Artem, I really appreciate you coming on here. I was very fascinated at some of the questions that were asked. They were pretty interesting and very interesting presentation. So you see Artem in my contact information. Feel free to reach out to him for more information about farmland investing. Feel free to reach out to me about self-directed retirement accounts. And join us next month. I think we're doing a precious metals related webinar that I'm going to be hosting again. So we look forward to it. Everybody stay safe and healthy. And Artem, thanks again for joining us.
Thank you so much, Bill.
All right.